Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures falling for a third day as the record-breaking rally in stocks cools. However, there is some good news on the economic front. The latest read of second quarter GDP showed the U.S. economy grew at the fastest pace in nearly 2 years. Inflation-adjusted GDP, which measures the value of goods and services produced, increased at a revised 3.8% annualized rate. Plus, on the trade front, the U.S. is potentially weighing additional tariffs on imports. The Trump administration has launched national security investigations into imports of robotics, industrial machinery, and medical devices. It's a move that could pave the way for fresh tariffs and raise costs for consumers, hospitals, and manufacturers. The latest probes expand the list of items to include personal protective equipment such as surgical masks, N95 respirators, gloves, and more. And Starbucks announcing a $1 billion restructuring plan. The coffee chain will cut 900 jobs and close stores as part of the overhaul. After a review of its coffee houses, the company identified a number of stores where it could not see a path toward profitability and decided to close them. It plans to focus on stores that align with CEO Brian Niccol's plan to make its restaurants a more inviting place to visit. All of this part of his turnaround plans overall. Let's go check in on stock futures right now. We are seeing weakness across the board here, even after that stronger than estimated economic data for the second quarter. We're seeing the NASDAQ lead declines as we continue to see concerns come into the AI-related trade. The NASDAQ indicating a drop of 0.7% at the open, the S&P a drop of 0.5%, and the Dow indicating a drop of about 0.25%. Let's dig into our top stories of the day now. Stocks falling for a third straight day as AI drags and Fed officials weighing in on the path forward for rates, plus the Trump administration launching national security investigations that could pave the way for more new tariffs. Joining me now, senior reporter Brooke DePalma live at the NASDAQ, Federal Reserve correspondent Jennifer Schonberger, and Morning Brief Market Sunrise host Ramzan Kamrali live from our London studios. Brooke, I want to start with you. This economic data coming out this morning, sometimes these revisions, you don't see much change, but here you picked up some growth in these revisions.
Absolutely. What we saw within with the revision of the GDP as well as the initial jobless claims is ultimately a stronger U.S. economy than what economists had expected going into this year, especially with all the tariff news as well. So taking a closer look at GDP, this was their strongest growth in 2 years. This is the third revision for the U.S. GDP. But what we saw was that the U.S. economy grew by a rate of 3.8% from April to June. This third revision now showing a higher rate of growth. And that was largely because of resilient spending, the release had said, as well as a lower import rate. Of course, keep in mind, April to June, there was a lot of higher tariff rates that went into effect. And so there was some retailers, based upon sources that I've spoken to, maybe pull back or pause or pull forward that inventory pre-April. So keep that in mind as well. But largely, this resilient U.S. consumer, of course, consumers make up about 2/3 of the U.S. GDP. So certainly a good sign there. And then on the flip side, we also got this better than expected jobless claims report as well. Jobless claims came in for the lowest since what we saw in mid-July, now coming in at 218,000 jobs or jobless claims, right, the first filing for these employees or people out of work. That was down from the expected 233,000 jobs. And it also was down 14,000 jobless claims from what we saw just last week. And so all this combined is certainly painting a picture for a stronger economy than we had expected going into the back half of the year.
And yet we are seeing, as you mentioned, as we've been talking about, stocks are lower, even in the face of this data. You do have some weighing from the tech trade, but Brooke, what are you seeing in the markets this morning?
Yeah, well, for the third straight day, stocks are expected to open in the red after Thursday, Friday, and Monday all those showing record highs across all three major indices. And now we've seen a bit of a pullback as investors maybe switch out of this risk appetite that they've been so hungry for over the summer months as these corporate earnings just continue to beat Wall Street's expectations. So we are seeing a bit of pullback as investors wait it out to see how exactly these corporate earnings will make their way into Q3 and what exactly they will say about the potential of AI in their guidance. But I also do want to take a closer look at something that is in the green this morning, and that is the 10-year T-note. We are seeing that pop about a little over 4 basis points as well. In addition, I also take a look at the 30-year bond yields as well. That also seeing just a slight pop, and you could see the momentum was really gained after these two reports that came out that showed the stronger economy. I also do want to take a look at the U.S. dollar because after we did see some downward momentum over the past few days, we are seeing the U.S. dollar now gain some momentum up about 0.4%. And this really points to this notion that this could lead to a slower path for the Fed to cut interest rates. So all this certainly something to keep a watch on.
Yes, most definitely. And then, of course, there is all of the extrapolation as to what the Fed is going to do. We get a little more insight into that this morning because we've got some Fed speakers. Jen, I know that you're monitoring that closely.
Hey there, Julia. We're getting some Fed speak crossing right now. Kansas City Fed President Jeff Schmid speaking right now in Dallas, Texas. Recall, he is a voting member of the FOMC, saying that he supported the 25 basis point rate cut last week, calling it a, quote, risk management move, and seemed to signal that he's not really in favor of further rate cuts at this point. And I just want to put this in perspective for our viewers, because last I spoke with Schmid back in August in Jackson Hole, he was more concerned that inflation was moving back up towards 3% than back down towards the Fed's 2% target. He was worried that if the Fed cut rates, they could ignite demand and thus inflation. But he said in his speech today, it was that weaker payroll data that we got for the month of August that seemed to concern him. That said, he said, quote, my view is that inflation remains too high while the labor market, though cooling, still remains largely in balance. I view the current stance of policy as only slightly restrictive, which I think is the right place to be. Schmid said he's going to be data dependent in terms of the path forward for monetary policy.
Interesting. And then Austin Goolsbee also making some comments this morning. What did he have to say?
That's right. Goolsbee speaking at a breakfast in Grand Rapids, Michigan, saying he's somewhat uneasy with front-loading rate cuts on just solely lower payroll growth. He said, quote, if we are in this environment where inflation's been above the 2% target for almost 5 years in a row and it's going the wrong way, just counting on inflation to be transitory makes me uneasy. And Julie, he sort of joked that the word transitory was used in the past. We know it was used by the Fed post-pandemic. And he said, look, I wasn't there at the time. You can't blame me. But he did say that if we were to see inflation sustainably coming back towards the Fed's 2% target, the job market hanging in there, then he thinks there would be more room to cut rates. But at this point, he's a bit uneasy front-loading or getting ahead of that at this point.
Well, let's now get to one of the things that the Fed is watching very closely in terms of its influence on inflation, whether it ends up being transitory or not. And that, of course, is tariffs. Ramzan, I know you're monitoring some of the headlines out from that. Let's talk first about Europe and the continuing sort of nitty-gritty discussions between the U.S. and Europe.
Yeah, so we kind of got some good news, actually, last night. The Trump administration formally implementing the US trade agreement with the European Union. So it's confirmed that 15% duty rate for EU cars and car parts. And they said that they would begin from August the 1st. So retrospective, they'll go back to August the 1st. Now, this tariff drop from 25% to 15% will essentially ease the worries in the car sector in Europe because they've been waiting for this long-delayed confirmation in order to make sort of their decisions when it comes to sourcing parts, etc. And it's not a surprise that shares of German car makers were higher, despite, as you can see, a sea of red across the main European indices at the moment. Now, Washington also listed tariff exemptions for generic pharmaceuticals, aircrafts, and aircraft parts as well. So this is a really important step in terms of Europe and US and their trade relationship, which has, let's be frank, suffered quite severely since January when Donald Trump took office.
Yes, find me a trade relationship between the U.S. and anyone almost that hasn't suffered. But let's talk about China and where we stand on that and the sort of back and forth again, sort of some maybe positive developments.
Yeah, so it's China and the US, we keep hearing sort of noises that perhaps they are moving in the right direction. But today, perhaps we've got some bad news because this is the message from China that the United States should remove what China described as unreasonable tariffs and create conditions to expand bilateral trade. That's from the Chinese Commerce Ministry when they were asked if they would purchase US soybeans. Now, remember, China is the world's biggest buyer of soybeans, but it hasn't bought any US soybeans from the US's autumn harvest at all. In fact, it's decided to buy its soybeans from South American suppliers instead. Now, US farmers could, miss out billions of dollars of soybean sales because of this sort of unresolved trade tensions that we have between the US and China. But it's also a bit of a strange one as well, because China's senior trade negotiator, he actually met business and political leaders in the US Midwest earlier this week, where the bulk of American soybeans are harvested. And he said that the world's second largest economy could purchase some American soybeans ahead of those more wide-ranging trade talks. But apparently this is all because of technical details that appear to be complicating negotiations. And that's why these purchases of US soybeans hasn't taken place. Remember also that later today, there's a lot of reports that Donald Trump will be signing a deal for TikTok so that they can sell their US operations here to a group which will probably include Oracle, for instance, as well. And that's seen as pretty crucial in terms of the trade negotiations between China and the US.
Yeah, I guess that's in the slightly more positive column when it comes to the back and forth. Brooke, Jennifer, Ramzan, thank you so much. Appreciate it. Coming up on Morning Brief, we'll bring you today's top trending tickers as we count down to the opening bell. Don't go anywhere. Now time for some of today's trending tickers. We are watching Starbucks, CoreWeave, and CarMax. First up is Starbucks, announcing a $1 billion restructuring plan. The coffee chain will cut 900 jobs and close stores as part of the overhaul. After a review of its coffee houses, the company identified a number of stores where it couldn't see a path toward profitability, decided to close them. It plans to focus on stores that align with CEO Brian Niccol's plan to make its restaurants a more inviting place to visit. Next up, CoreWeave, the company expanding its partnership with OpenAI by up to $6.5 billion. CoreWeave announced an initial agreement with OpenAI with a contract value of up to $11.9 billion in March. That was later expanded by up to $4 billion in May. So this deal brings the total contract value with OpenAI up to approximately $22.4 billion. It'll be used for the training of its most advanced next-generation models. And then we have CarMax, those shares plunging after the company reported a surprise drop in comparable sales as buyers had rushed to purchase vehicles in the previous quarter ahead of tariffs on imported cars. A 25% tariff imposed on those cars in April prompted consumers to accelerate purchases to avoid potential price hikes. Analysts had warned ahead of CarMax's results about this pull-forward effect. Right now, the share's down 18%. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, the tech sector looking to open lower after taking losses for a second straight day Wednesday. Multi-billion-dollar deals between the likes of NVIDIA, Oracle, OpenAI, and now CoreWeave, they've sparked concerns of a potential tech bubble forming. Could the FOMO trade be starting to waver? And how should investors be positioned right now? Joining us now, this is Adam Coons, Winthrop Capital Chief Investment Officer. Thanks for being here.
Thanks for having me.
So what do you think? Is this the end or a pause in this FOMO trade?
No, absolutely not. I mean, I think you've got a lot of things going on right now. There's a lot of focus on the Fed and interest rates, and people try to correlate that to how stocks, particular tech stocks, react. I think this is more just one of those stories where it's run really far, really fast. So to have a pause is healthy, but I think the momentum, it'd be hard to bet against the momentum right now. Do I think some of these companies have probably outpaced themselves? Yes. But when you look at the valuation of some of the companies like NVIDIA, I mean, it's still trading below 30 times earnings now. So, when you look at what they're doing and how they're executing, it should be no surprise that the stock is up as much as it is. I think where you want to be careful are the names that the valuations are just outrageous. It's hard because it eliminates the margin of error when the valuations are that stretched. It doesn't mean the stock's going to go down by any means. It just means that if the earnings come out and it is a disappointment of any kind, that stock is going to be punished fairly aggressively. So I think that's where you want to watch valuation. I don't think it's not going to be the entire industry. You're not going to see it roll over. I think what you're going to see is just name by name that may miss. And, because this is that kind of period where we're trying to figure out who the winners and losers are going to be, because we're still very early. We're probably third inning of this. So we're going to kind of have a long runway of ups and downs.
Yeah. So given all of that too, though, do you want to be defensive on the other side? Like have all that stuff, have the NVIDIAs of the world, but then also be a little defensive just in case?
Absolutely. So we're actually doing what we would call a barbell strategy, right? So, we're still taking that bet. That bet is probably a more defensive tilt on the AI bet, but elsewhere we are playing a lot more defense. We are paying attention more to valuation. We are, looking for those stocks that pay higher dividends to kind of offset, because the growing number of things that could go wrong, the term black swans, seems to be escalating. There's still a lot of geopolitical things that we haven't figured out. You obviously got rhetoric out of Washington, the Fed chair is going to change. So there are a lot of things that could change over the next 6 months, 12 months, that we still like stocks. We just want to be a little bit careful.
Gotcha. What does the defensive side of the equation look like?
Yeah, so, in tech, it's going very boring. Microsoft, Google. Right now we're staying away from Apple, or at least underweighting it. But then elsewhere, we're looking at healthcare. Lilly is a name we really like. There's just a lot going on in the healthcare space. There are some shifts, but we still like the weight loss story out of different names. So still heavy in that, but like I said, that still is a defensive play. And then, when you're looking in the consumer side, you're looking at, like I said, it's the more boring names. It's your Pepsis, your Cokes, Procter & Gamble. We think right now, those are the places you want to kind of, like I said, barbell, kind of hedge the rest of your portfolio in those, because that dividend, that means something. If the stocks are going down, that's something you can reinvest as markets may turn over. So, like I said, it's just looking at those lower beta, lower volatility names.
I'm also curious about the U.S. versus the rest of the world, right? Because that trade, the international trade, has really outperformed this year, which is ironic because it was sort of sparked initially by the heaviest of tariffs. Yep. The heaviest of tariffs have come off, but that trade has continued to work.
It has.
But, where are we in the sort of sell America mentality that came in that period of time?
Yeah, this trade's similar to value and growth. It's one of those where, growth outperforms, seems like every year. Then there's that one year that value outperforms. And this is similar. We've gone a decade where U.S. markets were the place to be, and this is the first year where you're seeing meaningful outperformance out of international stocks. So I think, there's merit to that. You saw a lot of outflows from the U.S. dollar. So, because if you think back to March and April, it wasn't just stocks that were going down. The price of bonds, because yields were going up. And if you looked at the dollar, we look at the Dixie index, that was also going down. So you could see everything that was U.S. was going down because people were pulling the money out. Where were they going to put it? They were going to put it into someplace. So international stocks, international bonds. So that wasn't a surprise. But it went too far. That is one area where we think that delta between U.S. and international just kind of was too large. At its peak, the difference between the two was about 17%, meaning the international stocks were outperforming U.S. stocks by 17%. So we took the bet that was going to collapse. And that trade has been working out international stocks are still outperforming on an absolute basis, but since April, you've seen that collapse to about 10%, the difference between the two. So we think that's probably going to continue, that shift towards, I'm going to call it normalization. With the hedging, what I'm saying, but it does matter what happens out of Washington, because as we know, something could come out tomorrow. There is kind of heightened rhetoric out of the UN meeting, obviously. And so there could be something else that could push funds back out of the U.S. But right now, when you look internationally, the economic story isn't that great. When you're looking at Germany and the U.K., there are a lot of issues, structural issues. So I think it's, for us, it'll be difficult to see capital flows move back out of the U.S. because, once again, where are you going to put it?
Yeah. And then just quickly, I want to end on a stock pick that caught my eye, and that's Reddit. Which is an interesting one, right? Because the company has sort of staked its future in part on AI-related revenue, right? Like kind of selling AI access to its content to train models. Is that one of the reasons you like it?
That is one of the reasons, but it's one of those that people have kind of forgotten about a little bit. It is a decent value. It's trading, once again, under 30 times earnings. So it was a name. It is a little bit of a out of our normal comfort zone, and so that's why we liked it. It's one of those, we're taking a small bet, we're positioned accordingly with it, but it's one of those where we think that when you look at the overall demographic trends of who's using that site, we see a lot of potential for ad revenue, the AI story. So yeah, we just see the momentum shifting back in their favor, primarily because of demographics, the AI story, and the like.
Do you use it?
I do.
Okay. I use it when I Google and it comes up. So sometimes then I end up over there.
The interesting information
yeah,
website,
exactly.
right?
Adam, thanks for coming in. Appreciate it. Well, coming up on Yahoo Finance's opening bid, our own executive editor, Brian Sazi, is the host of that program. Look, there he is.
Hey.
Brian, what do you got coming up?
Got lots of stuff, Julie. We're going to dig into some of this economic data out this morning. If you were looking for a rate cut, you definitely didn't want to see GDP at 3.8%. And also a big chat with Charles Schwab, CEO, as we witness this ongoing market melt-up. I'm calling it a melt-up, Julie.
Yeah, we've been calling it, I like it. It's a melt-up. Well, not the past few days, but maybe it'll resume. So looking forward to it. That does it for Morning Brief. Much more ahead on Yahoo Finance.